Hey, what's up you guys, it's Adri here, welcome back to my channel. Today we are going to discuss something that I have already touched in my previous videos, and that's dividend investing. Dividend investing is a strategy that offers investors two sources of income. So first, dividend payments, which are on a regular basis, either monthly or quarterly, and second, capital gains through appreciation over time. Dividend investing is a great strategy for investors that have little to no time to look for shares every single day and who want to generate easily passive income and accumulate wealth over time by simply applying the one-on-one strategy regarding dividend, and that's reinvesting dividend in the same companies in order to create compound interest and snowball effect. So you're going to put, for instance, $100 in one company, and when you get the dividends, so let's say you're going to get around $6 per year, you're going to take those dividends and reinvest them in the same company. By doing this, you're going to invest free money got from the company over, let's say, 30 years with an initial investment of only $100, because those dividends are more or less free money that the company pays you because you gave them those money in the first place. So you're going to gain an infinite amount of money once you withdraw your initial investment. Let's say you wait to 5 years, you're going to take out your initial investment because the stocks appreciated and it kept paying dividends to you. You reinvest meanwhile those dividends in the same company, and you get more and more dividends that you are going to again reinvest, and so on. And this is how you get rich and wealthy. Furthermore, there are certain types of dividend stocks that are even more intriguing, such as high yield dividend stocks. These stocks are usually great for those people who want to invest into a steady source of income through a solid company, and they want to look for something with low risk. So you're going to invest, for instance, let's say in Procter & Gamble or Coca-Cola. These companies are Dividend Kings. They have a rock solid business strategy and you have nothing to go wrong with here, basically, at the moment, until they might change their business strategy, of course, like General Electric did. But now it seems that they also recover because they had a lot of assets in the company that they could leverage in order to regain their substantial position on the market. So it went last year around $6 and now it's almost $14 again because they changed the management team. The CEO is doing quite great and he made a very unbelievable in the first place a promise to the investors and the board, but it seems that he can keep his promises. Maybe he just anticipated what the Federal Reserve will do and how the holding investors will react, but we don't know. What matters is that General Electric is back on track now. However, it's important to mention that even dividend investing is a strategy with pitfalls, because nothing is perfect in the world, guys. So let's see what are those pitfalls. But before that, we are going to delve into certain examples of very accurate dividend stocks that I trust in and I invest, and let's see some key fundamentals that everybody who wants to apply this strategy to his portfolio, her portfolio, needs to know, basically. I had to learn those before, and this is what I advise every single people to do, because you need to know what you're going to put your money into, right? Let's see. Some well-known dividend examples are those from companies such as 3M. They basically 3.6% dividend yield, which means $1.47 per quarter, which is basically $5.88 per year. And then you have Procter & Gamble with a 2.4% dividend yield, which will generate you around $3.16 per year. These are free money. Again, you buy a share and you get this money for free, and you have to pay no taxes in terms of capital gains, but just on dividends, which is at maximum 5% according to the OECD model convention. So most of these companies are registered within jurisdictions from developed states, so you don't have to worry that the UN model convention will apply with just the OECD, and they restrict dividend taxation to 5% at maximum. Then we would add here another company which is Lowe's or Lowe's. I don't know how to pronounce this, I'm sorry, I have to check. It's a 1.4% dividend yield, and it gets you 60 cents per quarter, which means $2.4 every year. This is a dividend payment for one share. And then one of my favorites, Coke. They have a 3.31% dividend yield. They give you every single quarter 42 cents, which means $1.68 for every share owned. Now, what you can do with these dividends? You basically are allowed to do anything you want. You can go out to have a pizza with your friends. O secundă, ai prins într-un moment mișto. Hai, zi că nu pot să opresc, filmam. Da, filmam și mai pot să pun pauză, zi. Păi, unde ești? Hai să nu mă după ce ești de la bancă că ies. Hai, pa, pa. Now, what you can do with these dividend payments? Basically, you are allowed to do, of course, everything you want after you pay the taxes, okay? So, you can go out to enjoy a pizza with your friends, or you could pay a bill, or whatever you want to do with them. But what I would do is one of the following things. I would first reinvest them in the same company if it's a Dividend King or Dividend Aristocrat. So that's my number one option with dividends received every single month, every single quarter. So I strongly encourage people to do this. This is not financial advice, but this is what I do. And as I always say, you do you, I do me. And I do believe that this strategy will get me where I want to arrive in life. Okay, then you could do something else. You could look for other stocks and invest in those stocks. So you're going to get new shares in companies with great potential according to your research with money received from another company. So basically you invest, let's say $1,000, you receive, for instance, let's say from AT&T, around 6%. So let's say you'll get around $60-70 in dividends every year. You now want to invest, for instance, in Realty Income, another great company for dividends, which has both growth in dividends and growth in shares. So Realty Income is another choice. I don't own them anymore, but I want to solidify my position in Realty Income soon enough this year. Okay, so now you're going to take dividends from AT&T, and because you believe more in the business strategy of, let's say, Realty Income, you're going to get around one share for free in Realty Income because you invested the money in AT&T and you got the dividends. That's quite awesome, I would say, because they can both grow over time, and you invested just $1,000 in one company and now you own shares in two companies and you can vote in both companies now. I think that's cool. It just brings me joy to invest, especially when I see that I get the dividends from AT&T, Coke, Procter & Gamble, Apple. Yeah, I think these are the most interesting for me. Yeah, I just like to reinvest those dividend payments back in the same companies. I just believe in them. Okay, so now let's see what you should know when it comes to dividend investing. Let's see some key fundamentals such as dividend yield, ratios, etc. Let's go deeper. Since I mentioned that there are two types of dividend companies called Dividend Kings and Dividend Aristocrats in this strategy, I'm going to delve deeper into this concept. So basically, Dividend Kings are companies that have paid the investors with dividend payments that consistently grew, at least with 1 cent, let's say, over 50 years. So Coke is a Dividend King. Then we have Dividend Aristocrats that are companies that apply the same strategy for dividends, so growth over time, but only more than 25 years. So those Dividend Kings are also Dividend Aristocrats because 50, more years than 25. Okay, Now I'm going to talk about dividend yields. The dividend yield is the annualized dividend payment as represented as a percentage out of the stock price. So if you have a company that pays you a $4 dividend and the cost of the share is $100, then the dividend yield of the company is 4%. So you have a share of $100 and you receive dividends annually, valued at a total amount of $4. That's 4%. You have to remember that a higher dividend is better for you, but what's even more important here is the ability of the company to pay out that dividend, because if you have a payout ratio of over 50-60%, it's not sustainable in my opinion. You have to get less than half in order to keep more money in the company, in order to reinvest and get more profits next year. So take care to get a company stock with high dividends, but also with a capacity to pay that dividend. That's the essence of dividend investing. So don't go for high dividend payments, because most of these companies are not sustainable at all. Think about AT&T, let's say. They are just on the edge, and this is a marginal example because AT&T is the second most debted company in the world, but they have a lot of promises and they have growth potential because they are a strong company over time. But another company that seems to be an exception is AGNC for real property, but I don't think that these companies are making much sense. But I think that usually companies that pay a dividend higher than 6.5 don't make much sense, except for strong companies such as AT&T, AGNC, etc. Even AGNC seems to be problematic here and there. But I still get on a monthly basis around 10% dividend, so that's fine for me. You judge. Then you have the payout ratio that I have just mentioned. The payout ratio is the dividend as a percentage of the company's earnings. So let's say you have 1 billion and the payout ratio is half of that. Then you're going to have a 50% payout ratio, and this should be, in usual terms, the maximum threshold that the company can offer as a dividend payment to its shareholders in order to still be able to pay those dividends in the end. So you should aim for a lower payout ratio, because what this ratio indicates is how much financial effort does a company in order to pay dividends on a quarterly or monthly basis, in the end on a yearly basis, to its shareholders, and how much money the company retains in order to reinvest and grow the business next year. So aim for around 30%, This is what I recommend. In general terms, lower the payout ratio, the better the company, but only when it comes to the sustainability of a dividend investing strategy. Then you have the cash dividend payout ratio. This cash dividend payout ratio means the dividend as a percentage of the operating cash flow of the company minus capital expenditures. This is generally a cash measure. So, cash is important because when things go bad for other companies, certain companies with a higher cash position is getting better deals because they avoid fees. For instance, for property transfers that notaries ask for, the state asks for taxes, bank fees for credits. So more cash a company has at hand, the more sustainable the business is. But not always. This is not a black or white rule. I'm talking only about dividend investing. So dividend investors can basically use this metric and the simple payout ratio in order to better understand the sustainability to pay dividends to its shareholders of a company. Other important metrics besides these ones, I would say that are the total income, because you get more money, it makes the business is desirable. desired by society, and people are going to get more of your products or services, of course. So let's see if there is a growth over time of total income. Then we have EPS, which is earnings per share. Usually now it doesn't matter how much it is, as long as it is positive, in order to see that there is potential of growth on medium and long term. Now it doesn't mean that if it's a negative, especially if it's in a range of 10 cents per share, it's not a good deal. It might be an even better deal, but you have to pay attention here, because dividend investors want to reach for an EPS that usually reaches around 60 cents per share, 1, 2 even. I mean, strong companies achieve easily around $2 or $3 earnings per share. I think Apple does around $3, if I'm not mistaken. Just let me know in the commentaries. And then you would have the P/E ratio, price to earnings ratio. We can get this ratio by dividing the share price to the earnings per share. So what this metric shows you as an investor, combined with the dividend yield, is the fair value of a stock. These are more or less the most important metrics when it comes to dividend investing. So be very careful when you choose your stocks for this strategy, because you need around 20-30 shares in order to build a strong dividend portfolio. And it can get really tricky, because it's a mainstream now with social media, when you are always advised to get Coke or Apple or etc., or even AT&T. But some companies do make sense, but some are just mainstreamed, and there is where you have to be less greedy and to pay more attention. You really have to do your homework here if you want to get deep into this strategy. It's not a part-time thing. I mean, you have to invest in dividends like you're going to do your preparation for the job on Sunday evening, and I hope you do that, because otherwise you'll get unprepped for Monday, and those that did their homework will shadow you, and you don't want that. So this is how dividend investing works. You design your strategy and your aim. You see how much you want to get. You see what are your financial means to invest in dividend stocks. You set a calendar. You're going to invest consistently over time, let's say 30-40 years. You're going to retire wealthy, I can assure you of that, but you have to do your homework at least twice a month, because things change, and you sometimes need to just take some of those and do a swap between companies, you know? So you can't always keep the same strategy, because things change, to be honest. Even if it's proven that over time you're going to get more, you don't just want to get a triple or X4 on your portfolio investment. You want to get around X15, X40, something like that, right? You want a lot of money to work. So in order to do that, listen to me. You have to do your homework. You can't just put your money consistently and hope for the best, because you found out in 2020 or 2021 that this is the way to get rich and you're going to do this no matter what. No, it doesn't work like that. You have to be focused. You have to know what you invest in. And how can you say that you know what you invest in if the last time you checked the company was 2 years ago? You don't know. Maybe they are in financial distress in Japan or in Poland or in, I don't know, sometimes even in the US, because life happens. You have to be prepared. So here are some key guidelines when it comes to high dividend yield dividend stocks. You have to pay attention to high yield stocks, high yield dividends paying stocks, because you will see that is not sustainable. And how you're going to see this? You're going to check the dividend payout ratio and the cash flow and the dividend history. I mean, you have to check if it used to be a dividend king and suddenly it stopped that increase in dividend payments. It's not dividend king anymore, because the streak got stopped. This changes everything for investors that put their money, especially because that company is considered dividend king. They are going to cash out some of the profits and most certainly swap to a better company that fits their strategy. So let's say that AT&T will not increase this year the dividend payment, and maybe not even next year. That's going to be an issue even for me, because I have a substantial position in that, and I invest in AT&T because of the dividends and because I actually love what they do. I love superhero movies and they own those broadcasts, but my money maybe should go to Verizon because they are better focused on their business. See how tricky is it? Another thing that you have to be very rational about is the industry. Why would you invest in something that disappears? I mean, we live in a digitalized world and you cannot suppose that if you invest in a hard industry, you're going to see substantial growth. No, because the potential of growth lies with the technology sector, not with, I don't know, furniture. Maybe, but actually furniture, I gave it as an example on purpose, is a growing business because there are more and more people. You see how tricky it is? You have to consider everything. You cannot just focus on 2 or 3 metrics and expect an all or nothing rule. No, it's not like that. Just make sure that what you looked for is accurate and it complies with what society requires. If you find this double match, you're simply going to grasp the best of the best. Now, since we talked about multiplying your initial investment, I'm going to delve deeper and present you a rule with a detailed example of how you can double your money. It's quite basic to think that you're going to double your money in around 7 or 10 years, but usually it happens around that time, even if you do not apply a certain rule, and that's with low effort. Actually, the most important rule here is what we call the rule of 72. You just take a plan, you analyze it, you see, you have to check basically what's the interest rate, what you're going to get on your initial investment, and you divide that the other way around. You divide 72 by the interest rate. So let's say you invest 100,000 euros and you want to see how long it will take to double your initial investment. What you have to do is to find a business strategy that is going to get you what you want, to be honest. If you're going to go in real estate, then a conservative rate would be 8%, maybe 10. But if you find something around 12 or 14%, maybe 15, and that could easily be achieved with public storage, you have to divide 72 to, let's say, 15%, okay? If I'm doing the calculus right now, that's going to be 72 divided by 15 interest rate, 4 years, 4.8 years. So how much is that? 10 months, something like that. Yeah, so in less than 5 years you're going to double your initial investment of 1,000. But what is very compelling is the fact that not everybody knows this rule and they just go with the flow, and that's the first mistake that an investor could do. You have to apply math and economic formula to see your return on investment. The average dividend yield is around 4%, 3-4%, it depends on the country, and what you as a dividend investor should look for is a company that offers a dividend above average, so let's say around 5%, 5-6% maybe maximum. Then consistency in payments over time, over 10 years at least, and whether the company offers a competitive advantage. According to a study I found, the Dividend Aristocrats Index has outperformed between 2006 and 2015 the S&P 500 is around 2.8% a year. So basically, in what the authors found is that this strategy will get you wealthy in only 27 years. That's extraordinary, coming from just dividend investing, which is really low risk. That's all for today, guys. Thank you so much for watching. Please subscribe and smash the like button. It helps so much the algorithm and ensures me that what I do is worth it. Till the next time.